Howdy, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, May 13th, 2025. Hope everyone had a wonderful Mother's Day weekend with their moms and their wives, their sisters, and all their aunts, etc. Just spreading the love. So, getting into our executive summary from today's leadoff morning note. As always, if you want to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is it too late to position for paradigm C? Our answers are stocks and bullish sentiment continued higher Tuesday after a 3.3% melt up in the S&P 500 on Monday, called bears offsides in response to the 90-day U.S.-China tariff truce. U.S. Treasury Secretary Scott Bessent called the 90-day tariff pause a very good framework for future talks at the Saudi-U.S. Investment Forum in Riyadh. Bessent also indicated to investors that the de-escalation was stronger than even the best hopes. The administration's strong desire to celebrate wins on the trade negotiation front is consistent with our long-held belief that the bond market broke President Trump on April 9th and forced his administration to pivot away from tolerating the pain required to transition to Paradigm B to celebrating the gains of an investor-friendly transition to Paradigm C. All told, incremental validation of our Paradigm C thesis suggests there is likely upside for both stocks and earnings from here. Per the latest Bank of America Fund Manager survey, institutional investors were a net 38% underweight U.S. stocks heading into last weekend's U.S.-China trade war detente. Another sign of the bullish Paradigm C times is Coinbase rallying 16% today on news that it will replace Discover in the S&P 500. These types of gappy up moves in names that are further out on the risk spectrum signal investors still have plenty of dry powder to invest. Our channel checks indicate still elevated policy uncertainty is keeping investors that mistakenly rely solely on fundamental signals to manage risk more underinvested than they likely should be at the current juncture. As such, we remarked a few weeks back on our friend Charles Payne's show, Making Money. By the time that uncertainty is fully resolved, it will be too late to position for and participate in upside risk. Transitioning to our 42 macro dashboard, as always, a wrap up with a question from our community. This one's titled, What Can Go Wrong in Paradigm C? It says, it appears we're getting confirmation after confirmation that Trump is adopting what Bessent laid out in his January 2024 letter to investors on what a Trump 2.0 term would look like, with a focus less and less on tariffs and used for negotiations, and more on a focus on, and more of if we focus on a weak dollar to create a domestic economic boom. So I imagine the goal from here is to grow our way into a more responsible deficit range by the end of this term. I have to think this is bullish for risk assets, but what could go wrong from here? Is it that the risk that the Fed ends up having to raise rates as opposed to lower, with inflation inevitably rising? I could see Jay Powell doing this, but whoever Trump appoints next year has to be someone willing to kiss the ring. Can the bond market wreck these plans? Ultimately, what could go wrong here in Paradigm C? Side note, I'm curious if Trump claiming he will balance the budget in his first joint address to Congress was written in his speech, or if he said that off the cuff, because I don't see a world where that is possible. So, thoughtful question, a lot to unpack here. So let me just kind of go through it, kind of in order here, just to make sure the answers are salient. So on this with regards to Scott Bessent's January 2024 letter, and with this Trump 2.0 term is going to have less focus on tariffs and more of a focus on a weak dollar. I don't know if I agree with that. I mean, our effective tariff rate has been taken back to a level that is consistent with Smoot-Hawley. So I think that's probably, I wouldn't agree with that characterization. This sort of focus on a weak dollar, in my opinion, is, I think, hard to do because on one hand, we've had a very strong U.S. dollar, and that's been persistent for almost 15 years now as a function of the capital inflows that we've Hoover vacuumed into the U.S. economy, partially as a function of U.S. exceptionalism, but more as a function of our fiscal and monetary largesse that created the U.S. exceptionalism that needed to be capitalized by the rest of the world, which ultimately led to our twin deficit position of 11% of GDP. When you're talking about these sorts of macroeconomic vulnerabilities like twin deficits, structural budget deficit of 7%, current account deficit of 4%. These are vulnerabilities that, can persist for an indefinite period of time unless you have a trigger to start to unwind those things. And it appeared at the beginning of this transition process when the Trump administration was, very keen to, or at least signaled that they were keen to bully the world into Paradigm B, that was a trigger to start to unwind those types of vulnerabilities and imbalances. However, ever since April 9th, it's been our view that they are pivoting us towards Paradigm C, which is essentially a continuation of the same thing from a fiscal and monetary largesse perspective, but also some incremental upside, supply side sweeteners that will boost growth even further. And so, in my opinion, I don't really see how you can have a sustained dollar bear market in paradigm C to the extent that paradigm C persists, maintains the U.S. economic exceptionalism. And in our view, it will be maintained if we can maintain the fiscal and monetary largesse that is supported, that exceptionalism is born out of. Again, you've 7% budget deficit to GDP year after year after year, and you're consuming 4% of your GDP's worth more than you produce every year, or you're saving 4% of your GDP's less than you're investing every year. Those are two sides of the current account deficit coin. If you're doing all that, of course, you're going to be exceptional economically. And so, in my opinion, it's going to be difficult to have a durable dollar bear market in paradigm C. It doesn't mean the dollar can't go down, but I think it's a lot more two-sided risk from here in that view. And so, getting back into the question, I have to think this is bullish from risk assets. What can go wrong from here? The number one thing we think could go wrong from here is if the Trump administration sees markets pricing in paradigm C and mistakenly takes that as a signal that they should, that it's okay to go back to bullying the world into paradigm B again. I don't think that's a high probability outcome, just given that the administration has broadly sort of pivoted to this kind of pro-growth, pro-markets phase of their agenda. In our opinion, we think the detox period that Besson was warning about back in February, and the period of disturbance, the economic restructuring that various members of the administration were signaling back in February. In our opinion, it just seems like that's over, at least according to our views and all the signals that we've received from the administration since then. So I don't know that pivoting back towards paradigm B is a high probability outcome, but to me, that's the number one risk, right? If they just look at the market performance and go, well, markets are doing well again. So if we want to get more and more headway, if we want to accomplish more on the trade policy front, let's go back to bullying the world in a paradigm B. So that to me, it's the number one risk. It's impossible to quantify that risk or appropriately handicap that risk. But again, not every risk in financial markets can be appropriately quantified and handicapped. At some point, you just have to take risk as an investor to make money in financial markets. You can't, you're just never going to have a guaranteed amount of certainty. And as we've been talking about, I said on Charles Payne's show, I said it again this morning, by the time there's no uncertainty, the markets will have already moved. You can't sit around and wait for certainty as an investor. So this is sometimes you just have to make just go with the highest probability decision, whether or not sometimes that high probability decision is 75, 80, 90% in terms of your assessment of that probability. But other times the highest probability decision is 51%. So what do you do with that? Well, you just got to do what you got to do as an investor and take risk. And so this is why we get paid by financial markets for taking risk, because this is hard. Getting back into the question, is there a risk that the Fed ends up having to raise rates as opposed to lower that with inflation inevitably rising? Less so. I think the Fed having to raise rates is more of a capital outflow story that's born out of a sustained dollar bear market. A sustained dollar bear would be really a function of the capital outflow story, and the Fed would likely have to keep rates elevated and or raise rates to prevent that kind of those kinds of capital outflows or curtail them to some degree. Again, we saw this on several occasions throughout the month of April when we saw various instances of the sell America trade. Now, again, I don't think that's where we're headed anymore. I'm just letting you know that I generally agree with this kind of sentiment. And then getting back into the question, can the bond market wreck those plans? Ultimately, what could go wrong from here in paradigm C? I think that's a very underappreciated risk in the bond market, is that the Trump administration taps essentially what will be a patsy to replace Jay Powell as the Federal Reserve. Jay Powell, in my opinion, throughout several times in this process over the past kind of 6 weeks or so, he was the only thing standing in between the U.S. bond market term premium from rising another 100 and 200 basis points and the bond market prices being fairly contained. Now, obviously, they were not on April 9th, on April 11th, or April 21st, but generally speaking, we've had some fairly tame bond pricing in the long end of the Treasury bond market, and that pricing will get very much uncontained, in my opinion, if the Trump administration appoints someone that is going to essentially run a kind of a structurally weak dollar policy, in the sense that they have policy rates much, much, much lower than they otherwise would be, according to the Taylor rule or just broader, economic and financial conditions. So just be aware of that. That is definitely a risk to the long end of the curve from an inflation expectations standpoint. And also you have the term premium issue that, in my opinion, is not very unlikely to go away. We're seeing some fiscal retrenchment as a function of Doge, but even if Doge is successful at accomplishing its entire $1 trillion target, which in our opinion, we don't think they're going to be or even want to be anymore. But even if they are successful at cutting $1 trillion out of annualized federal expenditures, you're talking about a budget deficit that's going to wind up at 5% from 7% prior. And then it'll start to grow again as a function of two things. One, the tax cut program that the congressional Republicans are legislating, talking about $4 trillion of tax cuts, but only 1.5 or even less trillion dollars in spending cuts. So you're going to start to add to budget deficits again from that starting point. At the same time, you also have some of these politically protected categories that aren't going to get cut, like Social Security, Medicaid, national defense, debt interest, and Medicare. Those politically protected categories are growing almost double digits on a compound growth rate basis, whereas, which is, that stuff's about 70% of the budget deficit. So the other 30% of the budget deficit has to compound down roughly 20% in order to keep the budget deficit flat. And so this has nothing to do with DOGE or anything to do with the tax reform or the tax bill. It's just the math of an aging economy and the math of recycling your debt to a higher interest rate regime. Those are just two factors that are ongoing and are likely to continue to supply upper pressure on the budget deficit over a medium-term time, over a long-term time horizon. So as much as they want to talk tough about fiscal retrenchment, the reality is paradigm C won't exist if they are serious about fiscal retrenchment in a way that, over the, let's say over the next 3 to 4 years, takes the budget deficit from, let's call it 7% of GDP towards, best since 3% of GDP. We think that's a pipe dream and it's very unlikely to happen. Incredibly unlikely to happen just based on everything we just said. But the reality is we could go from 7% down to 6 or 5 and back up to 7 or even back up to 8 just over the course of this Trump administration's tenure as a function for all those dynamics that we're highlighting. But at the end of the day, it's bullish. You're talking about pumping more and more trillions of dollars into the economy from the growth of the budget deficit. That's been the case for years now. And that's what part of the reason we continue to see. That's what part of the reason the U.S. has been exceptional and is likely to remain exceptional from an economic standpoint to the extent that paradigm C is the highest probability outcome. And as we said, we do believe paradigm C is the highest probability outcome. So finally, I think that was it. So yeah, I'll wrap it up there. I think I went on pretty long enough for this, but appreciate the always super thoughtful questions that are in our community. Even more so than the questions, I appreciate that we have thousands of investors, asking and answering each other's questions in here, and we're all learning together and trying to get to the right answer faster than communities outside of our paywall. And we're really appreciative for that. Appreciative for each one of you guys here on Team 42, and just want to say thanks for tuning in to these. We'll catch you back here tomorrow. Cheers.